Hello and welcome everyone. Today I am going to discuss on profit or loss prior to incorporation. In many cases, a company is formed exclusively to acquire an existing business unit and take it over as a going concern from a date prior to its own incorporation. In such cases, the business unit is purchased first and the registration of the acquiring company takes place later. For example, Sarvottam Private Limited is incorporated on 1st April 2018 to take over the running business of Uttam Brothers from 1st January 2018. The profit earned or loss suffered during the pre-incorporation period is called profit or loss prior to incorporation. In our example, the 1st January to 31st March of 2018 is actually the profit or loss of prior to income prior to incorporation. Legally, this profit is not available for distribution as dividend since a company cannot earn profit before it comes to existence. However, profit earned after incorporation is available for distribution as dividend. Profit earned before incorporation is a capital profit, and after profit earned after incorporation is a revenue profit. After incorporation, a public limited company is required to obtain a certificate of commencement of business. Here, the question may arise as to whether a pre-acquisition profit to be calculated based on the date of incorporation or date of obtaining certificate of commencement. The answer is the date of incorporation should be taken as the basis of calculation of pre-acquisition profit, since obtaining a certificate of commencement of business is purely a legal formality. The accounting treatment of pre-incorporation profit or loss is totally different from post-incorporation profit or loss. Thus, it is necessary to compute both the amount of pre- and post-incorporation profit or loss. There are two methods of computing profit prior to incorporation. Let's talk about the first method of computing profit prior to incorporation. Under the first method, a separate profit or loss account is prepared for the pre-incorporation period as distinguished from profit and loss account for post-incorporation period. On the incorporation date, stock is taken, a final account is prepared, and the old books of account are closed. This method of profit determination, though simple and accurate, is inconvenient and expensive because the business activities have to be suspended for a few days for stock taking. For these reasons, this method is not generally followed in practice. In the books of the new company, acquisition entries are purged on the same date after taking into consideration the assets and liabilities on the date of incorporation, which thus would include the result up to date. And the entries is like this. Here, land and building account, plant and machinery account, sundry debtors account, stock account, cash at bank account, cash in hand account will be debited, and also at the value on the date of incorporation. On the other hand, the liabilities account and vendor accounts will be credited, and definitely it will be at the value of the date of incorporation of purchase consideration. And the second entries will be vendor's account will be debit and the equity share capital account will be credit, and at the value of on the date of incorporation purchase consideration. So what about the second method? In the second method, there are 3 steps. At step 1, to prepare a trading account for the entire period, that is pre and post incorporation periods combined. And in step 2, to allocate gross profit and expenses, that is indirect expenses, between pre and post incorporation period on the basis of some principles. These principles is like that. The number 1 principle will be gross profit is allocated in the ratio of sales of each period, and another principle is fixed portion of expenses is allocated on the basis of time, and the expenses related to sales are allocated on the basis of sales, and expenses related to time are allocated on the basis of time, like rent, tax, insurance, depreciation, etc. And expenses which are exclusively related to pre or post incorporation period must be charged entirely to that period's profit, like preliminary expenses, directors' fees, debentures interest, etc. are to be charged against post incorporation profit, and partners' salaries, interest on partners' capital, etc. are to be charged against the profit of pre-incorporation period. In step 3, the net profit or loss of respective periods are calculated after deducting apportioned expenses. Accusation entries are passed at the end of the accounting year. And that's all for now. Thank you.